Welcome back. You're watching Market Guru. Chakri Lokapriya, CIO and Managing Director at TCG Advisory joins in. Morning, Chakri. Thanks for joining us. Chakri, it's all eyes on that policy. Last week was budget. We'll talk about that since it's retrospect and how in just a few minutes. But what are you expecting from Dr. Urjit Patel?
Good morning. I think it's time that we actually have this 25 basis point cut, which is long overdue. And, given the low corporate credit demand, and if you look at various parameters for the industrial sector, it's negative. And so I think it's time that we have a rate cut and to revive the growth in this country.
So, Chakri, if I had to fundamentally ask you this, what in your mind has changed from December to right now? Because I think the concerns that the committee members had raised was sticky core inflation, rising global crude prices, no pass on of a rate cut to consumers. And of course, apart from that, they said that the impact of demonetization was transitioning. Those were the concerns. Now, if I have to ask you this, core inflation has eased, but imported inflation is still a big concern. Crude prices are higher by 5% this time around as compared to last time. We all know that at least hard data for now has shown that despite 86% of cash lists in the economy, growth has been firm. And apart from all of that, we've actually seen a 90 bips rate cut being passed on in the last 2 months by SBI. So what in your mind, apart from a sentimental reason, could justify a rate cut?
I think there's lots of questions. I'll try and address each one of those. If you look at the way the pass-through is structured, it's only the new loans that are taken out by companies which enjoy the lower rates. The older contracts, the older loans still are stuck with the high rates. And those are actually the problem loans. So RBI should figure out a way to ensure that the old loans also enjoy the lower rates. Second, in terms of crude, while it has rallied, now, year to date, it is stabilized around that $50, $55 mark. And these numbers, mind you, if you rewind back to 2007, before the oil spiked, the Indian economy was doing well around that $50, $70 mark. So I think between $50 to $65 doesn't really hurt the economy. And second, whether oil prices go up or down is not in the control of RBI. And so it shouldn't be chasing things that it cannot control.
The bedrock, Chakri, of policy is inflation. And if inflation is going to be hit, even if factors are not in your control, like crude prices, I'd imagine you've got to be preemptive and fix that as opposed to leave it to fate.
Yes, and I think the same thing holds for the for outlook of crude prices. Because if you remove the outlier of that $140, crude has trended around this. The range should be going forward between the $50 to $65 mark. And so that way, monsoons we don't control either, and that drives inflation. So I think reviving growth should be a concern for the RBI.
Reviving growth should be a concern for RBI. Chakri, we've seen an over 2,000 point rally on the bank Nifty alone, and that's really been the driver of the smart pullback in the markets. What's the outlook going forward from here? Because in the whole conversation about demonetization, the fact that they are still struggling with NPAs, the PSU earnings that have come in so far still show elevated levels of stress over there. Provisioning continues to remain high. Profitability, though, has improved because that's also a favorable base effect playing out, continues to remain under pressure for some of these banks. So what's the outlook going forward? Is this positive cheer on the stocks only going to continue?
I think if you look at PSU banks and banking in general, credit growth is hardly 4.5%. This is like a 40, 50-year low. And second, industrial demand, which is supposed to be make in India and all those kinds of stuff, is actually negative. It's fallen 4.5%. So the only thing which is the saving grace has been services growth, which has been about 8-9%. And retail growth, which is probably about 14-odd-ish%. So, and this, if you look at in the budget, capital allocation by the government, by the finance minister is at 100 billion, is less than what it was last year. Clearly, it's not enough. And that's why the emphasis on growth becomes important. And again, the stock of the bad bank. So if you remove the bad loans, it eases up the balance sheets. Not only for the banks, on the other hand, the corporates also will start reviving the private capex. But valuations are very low, so I think banks are still a good space to be.
Banks are still a good place to be. What about the auto space? Because there seems to be no really stopping the move over there. So stocks like Maruti sitting at a life high right now. Tata Motors a little subdued, but the numbers continue to support the fact that there is demand, even if the demonetization pain was there for a month or so. Going forward, is this cheer only going to continue for the auto stocks? Is that a place that one should be betting on heavily?
If you look back the last 4 years, 5 years, 6 years, and autos as one space has continued to show steady demand in both volumes and prices. This is because of this huge aspirational thing of whether it's two-wheelers or four-wheelers, and therefore that has kept up demand. And plus you have the export demand. And then because of new technologies, the auto ancillary industries is also growing in space. Whether you look at various companies, Lumax, FEB, or Minda, these kind of companies, are using new materials to make their lighting, horns, car interiors, exteriors, etc. So cost is coming down, so profitability margins going up, demand, because India is still lots of people need cars and bikes, and as well as commercial vehicles. I think the outlook is pretty good.
What are you doing with metals, Chakri, right now? We've seen earnings from Tata Steel. They were much better than what the street was expecting. We were already going with high expectation, a clear beat in terms of what we saw. We saw Novelis, which also was better than expectation, giving us an indication of what we could expect from Hindalco. Both these stocks on the exchanges have been outperformers. How are you going to be setting your bets on the metal space? Because I know we are only seeing this upsurge, at least in terms of stock performance, on back of production cuts, not because of increase in demand in countries like China.
I think 2 or 3 things. If you rewind back again from the end of the financial crisis 2008-9 to now, Hindalco stock is probably where it was about 5 years ago, and metal prices are still way off the highs reached. And second, if you from a more medium-term perspective, so then you had in 2008 a situation where the global demand was falling, whereas now you have a situation where developed economies are accelerating for the first time after many years, whether it's the US or Europe. And that usually metal demand follows whenever developed economies accelerate. So I think the outlook is good for metal stocks.
Right. Chakri, what about the infra universe then? Because that also becomes a part of a direct play over there. You have government capex, which is the driving force down, record outlay for road projects, at least in the budget. But private capex continues to lag. Is this going to be the situation for some more quarters? Is there a complete reliance on the government as far as reviving the capex cycle goes? And really, how do you play the infra space then?
Private capex, we believe, will continue to be weak for the next 2 or 3 years, simply because capacity utilizations are still very low. And so the companies can produce more from their existing factories without starting new ones. And second, the bad loans bit needs to be resolved for private capex to restart. So then the whole thing, which is not a bad thing from a stock market perspective, because these private companies will enjoy higher profit margins, which will translate into higher multiples and higher stock prices. On the other hand, the capex. So we've had in India, I think, what is a jobless growth. And so the dependence will still be on public capex.
Right. Chakri, did you hear about or read those reports this morning with the corporate governance concerns being raised for a company like Infosys, known for its golden standard of corporate governance? Are you concerned about this right now? Do you think this could go down the Tata mystery way?
I'm a firm believer in the thing that if you pay peanuts, you get monkeys. And from that perspective, the compensation of a few top-ranked employees in Infosys or any of the IT companies should not be the concern, and that is not really a corporate governance, because worldwide the best producers are always paid. And therefore the focus should be more on the business and rejigging the business model.
So do you think Vishal Sikka is on track because I think for a couple of institutional investors have talked about the fact that while you had Murthy who under-promised and over-delivered, you have Sikka who said he's going to hit $20 billion of revenue by 2020. Very ambitious numbers, keeping the background in context. But if you look at what Sikka has done since he's come on board, he's working towards automation, he's working towards artificial intelligence, he's doing cloud, so of course moving away from the traditional models. And to my mind, that is the future, and that's what the IT industry is talking about. So to be fair to him, he's on track, doing the right thing, and I'd imagine that should be a big positive for Infosys.
Indeed. I mean, if you look at Toyota, for instance, the automaker, is going to spend $1 billion on artificial intelligence. So that's where the whole world is going, and it's rightly these IT companies are beginning to look at these new emerging technologies. And mind you, these new technologies are also higher margin revenues. So if they can successfully rejig their business model, it'll be actually a great thing in terms of profitability of the company.
But in the interim, what should you do with IT? Because the landscape, like you said, is changing. You have Trump tirade and the whole H-1B visa issue. If that does go through, then you are looking at elevated costs for them, more local hiring, and therefore some kind of impact on competitiveness as well as margins. In the interim, it's a part of every quality portfolio out there. But the stocks have been underperforming. What do you do with IT stocks?
I think the next 1 year will be a period of transition more for the Indian IT companies rather than IT services as a sector. Because if you have a greater percentage, I think the number is 15%, of your US headcount on H-1B visas, that's when the minimum wage thing kicks in. So it does not impact companies like IBM, who also have services business, Accenture, etc. And it impacts more the guys who have the higher offshore, higher H-1B visas thing. What does it do? So it cuts margins by a couple of basis points because you have to pay a higher wage. But my belief is, we believe that clearly some of it will be passed through to the end client. So it won't be, the margin hit wouldn't be as bad as expected. And second, I think this, for it to turn into legislation, is probably a year and a half away. So this gives sufficient breathing space for companies who are nimble enough to readjust to the new reality.
Just a final word on IT. Is the domestic pie big enough for these companies to possibly look at that as a growing strategy going forward? Or is the domestic order inflow, especially the kind of government orders that you get, still too small for the markets to then get excited about the companies that are playing that space?
India represents an extremely tiny portion of revenue for any of the IT companies. And so that's not going to change in a hurry in any time in the next 5 years. So in the interim, I don't think it can support earnings because of a loss of somewhere else.
What about pharma, Chakri, right now? Because, of course, apart from, it has been the darling of the street for a very long time, but the last couple of years have been rough. So be it a US FTA, European FTA concerns, product problems. And I know this industry, by the nature of it, is always going to be hit by regulation concerns. But keeping that backdrop in mind, Trump's commentary on how he wants to produce locally, reduce prices, it is one of the most profitable markets for Indian pharma players. Would you buy pharma keeping valuations in mind and the worries at hand?
I think pharma's issue started way before Trump. The FDA, higher scrutiny by FDA started a good year and a half ago. And that will continue. And it's also time to some of the Indian IT companies pharma companies to shape up to the new reality of greater compliance which is required. So that is going to be still a company-specific block and tackle kind of thing in trying companies which would...
Are you buying anything in pharma?
No, we are hugely underweight the sector.
Are you buying anything in IT? So, well, yeah, it looks okay, but would you buy IT right now?
IT, again, amongst the big, large caps, we are underweight. And with some of the mid caps, yes.
And going back to pharma, so what would be that trigger for you to go out and start buying pharma? I know it would be company specific. Is there anything that's on your watch list, to be fair?
The watch list would be, again, only company specific, simply because, well, you know, the usual, maybe Dr. Reddy's and Lupin's will be the first port of call.
What about Sun Pharma? Because I think that one has not been caught up in as much issues as the other guys have. Indeed,
but they still haven't resolved their legacy issues. And so it'll take time for them to fix it. And so IT as a space, and we being absolute return focused, it's a space that we are avoiding right now.
So what is, Chakri, sorry.
No, go ahead.
What is the space that you like? So, I mean, yeah, on a macro level, everything sounds and looks okay, when you're not actually buying those stocks. If I had to ask you, what is your portfolio constructed of? Is it cyclicals? Clearly, it's not defenses because you said you're avoiding that space. In cyclicals, is it banks? Is it rates? Is it real estate? Is it capital goods? Is it power? How are you placing those bets?
We have an export-oriented focus, companies which are either companies like Motherson Sumi or even Minda for that matter, who have a greater export component, or industries which are export-dependent, like metals, petrochemicals, refining. I mean, IT selectors.
Both the largest exporters
are not. Textiles is actually going to benefit. Defense is actually going to benefit with the new Trump-Modi kind of policies. And we're finding sufficient space because, if you within the sole petrochemical refining space, it's a very huge sector, and also the other sectors. So together, for an absolute return, there is enough out there.
In fact, Minda, which is on your buy list, looking at the stock over there, it's up 32% just this year. Of course, it's reacting to its earnings in today's move, but 32% of a jump coming in the last 40 odd days alone on a Minda industry. Even a Motherson Sumi, that is the other one, has made an acquisition lately. So that's just about up 5% for the year. But Minda is one of your calls, and that stock clearly is an outperformer, at least in 2017 so far. Chakri, what are you doing with the entire I asked you about infra, but really realty is the other pack that Samina was talking about, because let's look at the fact that the government is pushing towards affordable housing, but not too many listed players are there. For instance, we were speaking to Mr. Godrej the other day, and he said that they are now going to make a big play towards affordable housing. So that's Godrej Properties that's moving over there. Other companies are looking at that opportunity, but is there enough of a pool within the listed universe to take advantage of the whole housing boost that's coming in?
I think a couple of things have happened since the pre-budget, demonetization, after that the budget, which has made real estate a more long-tail event and therefore not as attractive as an investment for many investors. They've also taken away some tax advantages for making real estate. So that clearly lowers demand, where supply is fairly high out there. And infra housing low-cost housing is low margin. And so by definition, there are not enough opportunities out there, and it's a space which we're staying off.
What about NBFCs then? They were the market darlings pre-demonetization, saw some hit come in, but have recovered smartly. A lot of stocks over there, something like a Bharat Financial for that matter, that's recovered about 30% from its lows hit recently. MFIs have been doing well. Earnings so far do not seem to reflect the kind of pain that was expected to come from demonetization. Would that be on your buy list as well?
NBFCs corrected, and also the demand also fell. The demand fell about 9-10% for various NBFCs. The multiples are still fairly high. So that's a space which clearly it's a growth area, but right now we're not finding too much value in that space.
Chakri, how are you approaching the banking space right now? So I know while the growth is obviously with the PSU banks because the kind of markets that they cover, numbers, earnings, profitability sits with the private sector banks. So would you bet on the dark horse, which would be public sector banks, or would you stay with the private sector banks, which have a 30% weightage on Bank Nifty?
As you rightly said, I think the clearly numbers show that industrial demand is actually negative, loan demand that is. Whereas the only thing which is positive is retail demand or services demand, which is private banks. But again, if you go by the theory that, the bigger the problems, the greater the upside, it's the PSU banks. And also with now the stock of having these ETFs as a way to capitalize banks, that's probably an easier way to do that. And that should find takers as well. And given that, there are enough number of companies, you can structure in an ETF from various sectors to make it attractive enough. And so PSU banks, one, they are valuations are on their side, and if you look at a couple of the banks' results like PNB yesterday, you're seeing that the NPS is marginally coming down.
I want to talk about one sector and whether or not you'd buy into this and what stocks would you pick up. Relatively small in terms of the number of stocks, but the largest in the world. And I'm talking about the telecom space. So the consumption-wise, we have the largest telecom consumers in the world. Numbers-wise, dismal, disappointing, you can call it what you want. With, of course, Jio's entry, things have changed. Now we're talking about M&A activity with Idea and Vodafone, and I believe Bharti is expected to gain because of the excess spectrum that will now be available. How are you approaching the space? Is it now time for one to start looking at telecom with a different angle? And if yes, which one would be your topic? Would Idea be a buy because of the merger? Would Bharti be a gainer because of the acquisition there?
Telecom as a space, I think, has moved from a growth sector to a utility sector. And the focus is now on not profitable volumes, but just volumes. India has one of the low, it's a well-known fact, India has the lowest rates in the world, whereas the spectrum prices are probably one of the highest in the world. This kind of a mismatch.
India, the largest in the world again, right?
Indeed, so I guess but the prices.
Price and the volume revenue, so indeed, I guess, yeah.
Indeed. And all these companies did all these various stuff in the past, like acquiring companies overseas, and their balance sheets are really stretched. So to fix their own balance sheets is itself partly the reason which is driving these various acquisitions and M&As. And so from that perspective, probably Idea is a better place to be than Bharti.
Right, so then putting it all together, the factors at play, what are some of the key triggers that you're watching out for, apart from earnings, which is the most obvious one? You have 5 state elections coming up as well. 2 phases are already done. What else should we watch out for 2017?
I think India has now become a cyclical rebound story at some point in time in the future, maybe towards the end of the second half. And elections and politics have become less important because even this budget was more of a irregular budget, no fireworks. So I think the market has come to expect that more of the same. And so we will see a cyclical recovery. And no bad news is good news. So from that perspective, and right now is the export-oriented companies. As we go out in time, the Indian companies, the domestic-focused companies will pick up and will contribute to the growth.
Political developments in Tamil Nadu in the last 24 to 48 hours. Anything of concern over there? Because Tamil Nadu joined the Uday scheme when the change of leadership happened a couple of months ago. Again, there's a change of leadership that's happening at the moment. There is a revolt in the party as well. Anything that concerns you that should possibly concern markets going forward from here?
I think Uday scheme will continue to, hopefully will continue to be a part of, Tamil Nadu will be part of the Uday scheme from either dispensation. And second, it's all home to IT, auto ancillaries and the auto industries. But there have been no unrest or anything in the state, so it's business as usual, so should not impact earnings.
Right. Chakri, what I want to get from you, so I guess we've done a pretty sharp run-up from levels of 8,000 to 8,800 now, 10% in the last 1 month. I know for a fact, or I'd imagine FIs are now going to start feeling a little left out in that regard. Are you expecting panic buying to emerge from FIs? And of course, for retail investors as well, who haven't actually participated, because I guess they're the last ones to catch the rally, what would you advise them?
2 or 3 things, if you just break it down into 2 or 3 time frames. From September of last year to November, December, when demonetization happened, the rupee fell in a matter of 3 months, it fell close to 3%. Markets fell 12%. And so the FI impact was 15%, more or less. And then after demonetization, some amount of normalcy, US came to power with a growth policy, Trump came to power with a growth policy. Developed markets are reviving really faster than expected. And as a result of that, and also after this budget, fiscal deficits, etc., were in place, no negative surprises, has allowed the rupee to appreciate. So what fell? The market fell 12% and it rose 11%. So we're back to where we kind of started in the past. So it's not overheated. And second, with the rupee kind of bottoming out, i.e. that is if you don't miss this fiscal deficit which now we have met, and there's some expectation of growth coming back, then FPIs will start coming back because it's both growth and the rupee outlook is important for FI inflows.
Right. So near-term target on the Nifty? 3 to 6 months?
3 to 6 months, I think we are higher easily in a 5-7% from
so
here.
new life highs should be a given.
Indeed.
And are you expecting mid-caps to continue with their outperformance, or will the benchmark now start catching up? It's been 3 years.
Indeed, if you look at any of the stocks still, still the multiples are pretty reasonable with the growth out there that we are seeing in the mid-caps. So that way, yes, we see mid-caps outperforming.